following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome back to the Option Block, your bi-weekly source for all things options related. A little bit of options wit, a little bit of options wisdom, and a sprinkle on the top, the cherry on the top, if you will, of some options fun / hilarity. Speaking of fun and hilarity, my name, of course, is Mark Longo from the OptionsInsider.com, the Florida branch right now anyway, which is why it may sound a little bit different, dear listeners. And I am also joined on the program by our usual cast of characters, starting off with the man beaming in from the great state of Maine. He is none other than Mr. Andrew Giovinazzi. You may know him as the Rock Lobster from OptionPit.com. Mr. Giovinazzi, welcome back to the program, sir.
It is a pleasure to be here. Pleasure to hear your that mellifluous sound of your voice.
How did I know you were going to go with mellifluous? As soon as you started talking, I just knew mellifluous was coming in some way, shape, or form. I guess we've been doing this show together for a while, so we starting to fill in each other's sentences. Hey, I am in your time zone for a change. I'm about 1,000 miles away from you, but I am on Eastern time, so maybe that's why we're in such simpatico today.
Well, you know what? It's a nice way to be here on the eastern seaboard. When I lived in California, I used to call it the least coast, but now, since I live here, I no longer call it the least coast.
And also joining me, beaming in from the center of the country, anchoring the show today, if you will, from the heartland, and trying to peek his head out from amongst those crazy storms you guys are having up there. You know him, you love him as the Viceroy. He is Alex Jacobson from Options Express. Alex, welcome back to the show. Sir, hope you're staying safe and dry up there.
Yeah, drove home through a hailstorm yesterday. That was some interesting weather. Rushed to get home so I could watch the Hawks game, and it took as long to get to the Kennedy from here as it did to get from where I got on the Kennedy to Deerfield. So, yeah, but it's beautiful today. It's sunny. It's in the 80s, and all is forgiven. The storms are past.
Yeah, beautiful day down here in scenic, sunny Florida as well. I'm sure we'll be due for our daily thunderstorm any moment now. It seems like clockwork. It just rolls in around 4 or 5 o'clock. But other than that, it's been lovely weather down here in the southern branch of Options Insider. Perhaps we'll look into establishing a more permanent residency down here in Florida. But for the time being, we'll just keep on rolling right on into the trading block.
The Trading Block.
All right, and welcome to the Trading Block. This is, of course, the portion of the show where we discuss what was trading, what was moving the old markets today. And this is another similar one, not as bad as it has been in weeks past, Alex, where you kind of look at this at the markets and you see what the narrative is around midday to the later part of the session, and then you can kind of not maybe tear it up, but you have to make an addendum towards the end of the day because we had a significant rally today. A lot of that coming on the close. If you looked at the sessions, about an hour or two before the close, you saw we were up handily on the day, but we closed up even higher still. Most of the major indices closing up well north of 1% on the day. The S&P closing up a full 1.5% today to 1636. The Dow following suit up about 1.25 to 15,176, and the good old Nasdaq up about 1 1/3 to 3,445 on the day. And following suit, the old VIX cash, ye old VIX cash, if you will, down about 2 1/4 handles or so to 16.43. Let's start there, Andrew. There's some interesting stuff going on in VIX land, not the least of which being your cohort, your life companion, your partner in crime, Mr. Sebastian, writing on your blog and on the Options Insider today about how the VIX is perhaps poised to start going backwards. So what are we seeing with that today, and how did that trend develop throughout today's session?
It started going backward, and then it stopped. Real simply, it looks like, rumor or something, maybe the Fed is not going to raise interest rates as fast as everybody thinks, and the market immediately took a little whiff up. So, but yeah, as of this morning, the market did not look very good. Volatility was going up. Actually, the VIX actually never was, I believe, was never up on the day today. It sort of vacillated a little bit around. It was a little bit up on the opening when the market looked kind of soft. And then it kind of spent the rest of the day just pooping out. So we did start to see that backwardness, but it's one of the crazy things. Okay, so the Fed might not raise interest rates super fast, and everybody felt good, and then jump back in again. And it pretty much killed. The market had an orderly decline, even though the vol was getting higher. It should be. So we got basically a small amount more backwardation, and then as soon as the market reversed, all the futures here closed in contango again.
So is that a technical term, pooping out?
As in the volatility pooping out, or
either way, whichever way you want to take it.
Yeah, you could say that. And now we're looking at, okay, what's the market really going to do? And now we're back to living and dying. I was happily getting the Fed slowly out of the market, and just it kind of is going to go south where it goes, but they got to stick there. You got to have the Wall Street Journal rumor to kind of jack the market up again. So that's where we got the last piece of that rally here at the end of the day.
Yeah, the bulk of that rally early in the session came from a lot of economic data showing that the economy may have some life in it yet. Jobless claims fell by about 12% last week, which sparked the early part of the rally. And then later in the day, as Andrew mentioned, we got some rumor mongering that kicked the rally on into high gear. So interesting stuff to see unfolding in the market. And, of course, speaking of things unfolding, this is actually a story I wanted to touch on probably a week or so ago. We just never got around to it on the show, but it's an interesting one nonetheless. Of course, this is very near and dear to us because we do so much insider activity and unusual activity here at the Options Insider and, of course, on this program, and just had the unusual activity event. And one of the key points we discussed at that event was how infrequent prosecutions are for insider trading in options. Well, we finally have a relatively high-profile case on the horizon here. We saw a man from Thailand a couple of weeks ago coming in, making more than $3 million in profits from what are being termed highly suspicious. I think we probably have some other words for them if they were on the option block here or on the odd block segment today. But trades in Smithfield Foods, and they were interesting for a couple of reasons. First off, from our perspective, this guy used options and is getting caught for it, which is a very unusual thing in and of itself. We highlighted at our event that in 2012, there were 58 total prosecutions or events that the SEC actions the SEC took for insider trading so that lowers your numbers in and of themselves. You're one of 58 if you do get caught. And then, of course, the number of those that actually involved options were minuscule. So your chances of being caught were pretty low. But we're seeing somewhat of an increased focus on that. This is a 30-year-old guy, employee of a plastics firm, reaped a 3,400% return. Not bad. Over 8 days, buying thousands of Smithfield call options. And interestingly enough, he bought the standard out-of-the-money call trade, which we talked about time and again here on the Odd Block. But he also bought single stock futures. I wonder if that's what actually triggered the enforcement on him. Someone said, "Wait a minute! Someone actually bought single stock futures. Let's trigger an investigation immediately." Because you don't see that at all. I've never seen any complaint come across about single stock futures. Alex, this one probably caught your eye as well, I'd imagine. Have you ever noticed anyone getting flagged for single stock futures insider trading in the past?
No, I think that's the first time it happened. But let me add some color. Because it's an Asian customer, coming out of Asia, you're coming out of an environment where CFDs, contracts for difference, are very, very popular. And they're not legal here in the United States. But the single stock future, although it's not a pure contract, CFD contract for difference, is kind of a close replication. So I'm assuming maybe it's something that the alleged insider was comfortable with. Interesting comment. A couple days ago, we had Dole up on the unusual activity, and a couple days later, it got a bid too. So it's clear that, some of this stuff is worth paying attention to when unusual activity gets showcased.
Yeah, there is mountains of data literally supporting that claim and how options are probably the best indicator for this type of thing. I ran through a bunch of it at our event last month. If you weren't able to come to Chicago and you did miss that, we are going to be putting up videos and recordings and webinars from that on the site shortly. We haven't worked out exactly the best way to get that out to you, but don't worry, all of you who did miss it and have been writing in saying, hey, we want to get access to that material, it is coming soon once we get all the back-end stuff set up to distribute that to you. Hopefully in the next few weeks we'll get that out to you so you can check out some of that data for yourself. But I highlighted a lot of studies that show that exact thing, that options volume spikes even on quote-unquote, or I should say ahead of quote-unquote surprise announcements, perhaps even more than it does on things that are scheduled, like earnings announcements and other things like that, which is your first flag that, hey, someone in the options market may indeed know something. Speaking of knowing something, or perhaps maybe not knowing something, depending on your point of view, we've talked a lot on this show, and certainly just in general, a lot of the industry shows have gone on and on forever, beating the drum about high-frequency trading and HFT in general and how it is the boogeyman of all things in the marketplace. We poo-pooed that a little bit here on this network because we haven't seen HFT really penetrate to any significant degree in the options market. And now we're seeing some interesting stuff coming out of the stock realm that maybe this big boogeyman of the stock world has perhaps hit its peak as well. Two stories coming out, one from Traders Magazine, the other one from advancedtrading.com, both pretty much highlighting the fact that HFT is apparently on the downturn. We see a study, first off, our friends over at Rosenblatt citing that from 2/3 of all stock trades in the U.S. from 2008 to 2011 were executed by what firms that would fall under the HFT banner. Today, it's about half. In 2009, those firms moved about 3.25 billion shares a day. 2012, it was about half of that, 1.6 billion. And also, there's less money to go around in these firms. One guy even saying, of course, that the easy money is essentially gone. That is a logical progression that follows a lot of these advances. We saw the same thing in options in the 90s and other areas where these relatively new concepts become grasped by the wider financial realm. And the easy money, the correlation trades and the quick types of trades tend to go away, and it becomes more difficult to execute this time and again. We've talked about HFT on the show a few times, particularly back in the days when Citi, a little over a year ago, was the main driver of HFT volume. That one, when that stock reverse split, it seemed to really put the brakes on a lot of the HFT guys out there. They'd never really found another mecca that rivaled Citi in terms of just the perfect scenario for HFT trading. Now it seems like the data out there is pretty much falling in line with that. So perhaps after all this talk about HFT being the boogeyman, ruining the marketplace, squeezing out the market makers, which certainly there was a lot of that going on, of course, and having all these other negative impacts, it seems like the tide of HFT has perhaps peaked. Alex, so what do you think about all this data coming in about HFT perhaps having come off the top of the mountain there?
You know, I look at a quick benchmark, which is Getco's earnings. And, 2012, they had a very difficult year. If I recall, their earnings were down like 85 or 90%, some dramatic decline. 2010, 2011, everybody was trying to build a high-frequency trade engine, and there were a lot of, I don't know what the term is, easy pickings in the marketplace, but everything I see and hear and read and interact with is spot on with what you're saying, Mark. It's changed, and it's not the business it once was. You're not making the money if you built the big high-frequency algo engine that you were, and things are getting back to kind of a more normal level. The interesting about the market, this is kind of my own opinion, is every time somebody comes into that market, whether it was the SOS bandits or the Raise bandits or the high-frequency people, they always make the argument that they're adding liquidity, but generally they're only trading in the things that have fabulous liquidity already. So we've seen these trends come and go, and it looks like high frequency is kind of running the course and declining here.
Yeah, if you look at just where the rubber meets the road, which is, of course, their profits and how those firms are doing, you're right, firms like Getco have been struggling. They had some very high-profile layoffs last year. A lot of these firms that are ostensibly the ones reaping all these profits in this realm seem to have fallen upon hard times, and if that's probably the best indicator you could see that the initial wave and the initial quote-unquote free money for HFT has probably dried up. So interesting stuff going on there. Yeah, a couple other things to hit on before we dive on into the odd block. We talk about VIX and VXX options all the time on this show. We've mentioned many times now over the last month or so that VXX has kind of hit this trajectory that no one could have foreseen just a few years ago, becoming, depending on the day you look at it, the number 3 or number 4 exchange traded product by volume out there, which is sheer insanity that an ETF on the implied vol of the SPX would reach such record heights. And now to go along with the underlying doing so much volume, of course, we're seeing records out in the options as well, record amounts, I should say, of open interest. Looking back to last week on the 6th, we saw an all-time high of about 3.5 million contracts open on VXX. This, of course, this data coming from our friends over there at Bloomberg, which is, of course, a record for VXX. Andrew, this must make your ears turn red and just shake your head in disgust that a ETF that you've described many times as predictably crappy is doing such banner business out there.
Well, but it is predictive. I mean, the best thing about trading is you want something that's predictable. So it is amazing to me that it does generate the volume that it does. But it's also the most accessible way for people to trade volatility in the large indexes in a relatively direct fashion. There's a lot of permutations of how it moves, but it's kind of like why the GLD is so popular, or the USO, or UNG, or any of these products that have this real yield issue. They trade anyway because it's the closest way to trade a thing. As long as you understand how it works, it's a good trading vehicle. But yes, it is definitely the VXX is 20 right now, and my guess is by the end of the summer it will be 12.
Hey, predictable crappiness.
It is predictably
as long as it's
crappy,
predictable.
Except for those moments of sheer terror when it's not.
What we saw from TVIX is that it was unpredictably crappy, which is doubly dangerous.
Right, exactly. And I think that's the biggest disservice is, you're buying it and you have zero, at least you get an idea, you have an idea of what you get with VXX. unless, of course, they start doing screwy things with it and not issuing more units. And, if there's net asset value problems and all that, which seems like they pretty much avoid it. And that's probably why it trades and the TVIX does not trade anymore.
And one last thing just to hit on, we talk a little bit here about the different exchange things that are going on. Of course, a lot of action going on in the options exchange space these days, including the SGMO dealing with a number of different issues from the SEC and investigations and being fined a record $6 million for their lapses in supervision. This follows on the heels, of course, of NYSE getting fined last year $5 million for data dissemination violations. And so between those two, between NYSE and now SGMO, before that, the SEC had never really imposed a monetary penalty like this on an exchange. So perhaps we're entering some interesting waters where in the past the exchanges kind of held themselves up as public utilities, and so they weren't really subject to these types of fines. Now we're in an era where all of the exchanges, or pretty much the vast majority of them, are for-profit public entities. They have shareholders, they have analyst meetings, and all these other things, and they're doing all these other things to generate business as any for-profit company would do. So perhaps when they push the envelope a little bit too much and fall behind some of their other obligations, they should pay the fines that any other for-profit public company would. And it looks like the SEC is looking at it the same way. So it might be an interesting space going forward for the options exchanges and others who have these regulatory obligations and now are starting to face some heat perhaps from the SEC. I wouldn't be surprised if we start seeing more of them starting to make the decision that SGMO seems to be wrestling with now of whether they should even bother with the regulatory function or if it's just too much of a conflict of interest with all the business development, other things that they do that are for-profit business development enterprises under the same banner. Interesting stuff. Just wanted to highlight on that before we dive out of the old trading block. Of course, that is relevant to us here on the show because SGMO rallying yet again, despite all this news, up about $0.75 to close at 42.25 today. That's insanity. I thought when they surpassed 30 that they had hit their high, but SGMO rallying north of 40 and not looking back, at least not anytime soon. So interesting stuff unfolding out there in the exchange space. I remember when that stock launched, I traded, I think, a 10 lot of options out there, and I did 1/10 of all at-the-money volume for that day. It was just a very, very illiquid, very quiet name. And fast forward a few years, and they're a little bit more viable, a little bit more tradable these days, and they do a little bit more volume. So from an options perspective, names like SGMO may be a little bit more relevant to some of our listeners. I'm looking here, they averaged about 2,500 contracts a day, which is not a ton, but substantially north from where they were trading just a year or so ago. And with that, we're going to close out the old trading block for today and roll right on into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the Odd Block. This is, of course, a portion of the show where we look into the interesting and or the unusual trades that are highlighting the options space or moving the ticker in the old options market. And sometimes, on occasion, we can potentially make you money. Let's go back to what Alex was just referring to a week ago on the 6th, this show 1 week ago, where we discussed a very sizable unwinding of a collar out there in Dole. At the time, Dole was trading up about 30 cents to $9.64. And we told you about how someone was unwinding the July 10, July 8 collar for about 20 cents. He bought the call back, sold the put. Now, you know when you put on a collar, you're buying a put and selling a call. You're usually doing that because you don't think the stock has much upside and you're worried about some downside retracement. So you want to get some protection for a reduced rate, so you put on a collar. When someone goes to these steps and unwinds that collar, it can mean one of two things. Either this person is unwinding the entire position and perhaps getting out of the underlying, or as it looks like was this case, this guy had some very well-timed bullish sentiment here on Dole, and he unwound this collar just in time to benefit from the pop we saw today. Dole, of course, having some corporate actions in the win today, trading up 13 cents and gapping up over the last few sessions to $12.72 now, so a full $3 from where it was trading just a week ago. Yes, very well timed. So see, Andrew, we filed this last time when we talked about it under the keep an eye on it. Yep. Didn't have to keep an eye on this one for too long.
Nope. Amazing. Let's see, how many days was that? Oh, 5. So the key thing with looking at some of this volume and dividing, which, we put these stats out, is one thing, a key for listeners is look at the open interest today and look at the open interest the next day, just to confirm that what my, highly attuned sense of open interest radar or unusual activity radar is trying to divine. What I found that was interesting and most about this thing is the guy had huge open interest, totally unwound the open interest, and then did not put it back on again. So that could be I think that's just as much a tell if the SEC listens to our show. There's all kinds of little goodies and ways to beat the system, and it looks like they thought of another one there. So I'll just unwind my collar quietly.
Exactly. Usually with these types of trades, you'll see someone take it off and then readjust it. Maybe he'll move it up to the 10-12 range, and so he'll hedge on the 10 strike and then right on the 12 or something like that. That's what you would traditionally do if you were just adjusting your collar in a routine fashion. The fact that he didn't do that shows that he, at the very least, wanted to keep his upside open for whatever was perhaps looming on the horizon for him. And in this case, I don't know who's acquiring Dole. I haven't looked at all the news of what the deal is, but it looks like they're having some substantial corporate actions going on today.
The guy that owns most of it is buying it back, David Murdoch.
Yeah, it's an insider taking them private. It would be interesting to see, and it's not information that files on the same day. If there was a 144 filing when I'll say they took the collar off, because potentially this could be a legal trade, and it could have been the insider doing the 144 filing and taking the collar off and then making the offer. I know there needs to be a time gap, and I'm not an expert on what the rule is, but oftentimes with some of these unusual large blocks, it's curious to see if there's a 144 filing, an insider publicly talking about what they're doing, because, again, that is kind of, instead of just looking at the volume, if you can look at the 144 data, the way I was taught the business, that's like playing poker, and if you've got the volume and good 144 data, now you're betting with a pair of kings instead of just one king. So it'd be curious to see, this may be the insider, it may be a leak, but it'll be interesting to see what the 144 filings look like in this.
But you're right, Alex. It is very, very suspicious timing. Of course, someone with some sizable Dole underlying position that typically falls into the insider category, unwinding it ahead of an insider takeover of the stock. That tends to raise a lot of red flags. I believe it was, 16,000 contracts he was doing, so that works out to about 1.6 million shares, which is about 3% of the outstanding float. So that's a substantial holding if that was indeed our insider friend here striking while the iron was hot or perhaps about to be hot. But interesting stuff. So listeners, pay attention to the old odd block, because we can make you money on occasion. So Andrew, aside from Dole, what else caught your eye in today's hive of scum and villainy, a.k.a. the odd block?
There was actually some strange, I'm just going to say, let's just call it slightly strange activity today. A stock we had highlighted, I believe, before, Quicksilver Resources, 2 separate trades, KWK, where the paper selling, or the paper was buying, what I believe anyway, buying the June 10 puts or the June 2 puts for 10 cents 2,500 times. Now there was at least 2,500 contacts of open interest. So my assumption is they're just closing that, and they made whatever money they made on it. It is not clear if they took all that money and rolled it to buying the SEP 32 calls around a big block of 1,485 traded for 32 cents, but is actually the volume was more like 2,000 contracts. And it looked like the 35, there was a 35 bid in the calls. It looked like it was sold down, and then they traded 32 cents. So kind of, I would say it's kind of funky volume. It feels kind of like it could be paper writing against, but at least the implied volatility to me telling the story of they're buying the June 2 puts and selling the SEP 2 calls for 35 cents, possibly. You know, the only thing I could think of is that's a pretty aggressive call sale naked. So to me, I would think that would be a like somebody creating some sort of synthetic on the trade.
Yeah, and there are, like you said, about 2,500 exactly of those June 2 puts, so that's clearly the closing leg of the transaction. And, of course, all of this must just be driving Alex crazy because, again, we're talking about a $2.09 stock. Trading 5,000 contracts on a $2.09.
Exactly. But OX will be happy to execute it for you and make sure you get an excellent fill.
Call Alex, and he will route you to the appropriate person to handle your 5,000 contracts on a $2.
Okay, and coming from the confusing trade of the day. So here's one, Monster Worldwide. I don't understand the purpose for this trade, but there must be. The Monster Jan 2014 10 calls traded 10 cents. When I looked at it, the block was 6,991 contracts. Average daily volume now, Monster Worldwide. It used to be a trader, but not much more. It's now trading only 727 contracts. Open interest, 21,000 contracts. And it looks like somebody's basically, they're long these calls and giving up. It looks pretty clearly they were hitting the 10-cent bid trying to get out of them. So is it a 10-cent bid posted that's trying to get filled to close? But it really what it looks like is just maybe the long seller bailing at a dime. If
that's the case, looks like he's got some more to go. There's 21,000 open on that strike. He's got 2/3 of it still to go. So that dime bid wisely vanishing. He got all of it he could, and there's no more. Now they're a nickel at 15 cents. So this guy obviously had some hopes here for Monster Worldwide. We've talked about, they've been on the odd block a few times recently. Yep. Because we've, I can't remember the last time we talked about Monster, and then in the odd block we talked about them several times, it seems like recently. And we had this conversation then about really who still uses Monster. Are they still the leading source for this kind of thing? Apparently this guy having the same discussion with himself, a nice internal monologue, because he's dumping out of this very substantially bullish. The stock needs to nearly double at this point. It's trading $5.54. So he's got a long way to go for these calls to be worth anything. And I think he's finally
it looks like he's dumping.
Yeah. Good luck on the other 14,000 or so there, sir. See if you can get them off. Probably
exactly.
For a nickel.
And I got one more for you because we did Dole. An interesting one, Sangamo Biosciences. It wouldn't be the odd block without some obscure biotechnology stock.
You got to give us a ticker on that one because I can't begin.
Yeah, I know that just rolls off your tongue, right? SGMO.
Oh, my favorite. Check that every morning. It's in my watch list.
Right on the top of your watch list. Stock trading in the middle of its range. And the Jan 2015 710 call spread traded for $1, 20,000 times. Average volume is 1,850 contracts. The thing here is the open interest on the 10 strike is a little over 20,000 contracts and almost no open interest on the 7 strike. So, to me means they're closing the 10 strike, reopening on the 7. And what I think somebody did is they bought like the 10, and I believe it was like the 10-12 or 10.
Looks like 10-15 here.
Yeah, they might have bought the 10-15 spread at one time. And they're like, the stock hasn't done very much. I want to sell out my 10s and maybe roll down to the 7 calls. And now they've got the 7-15 call spread on and looking obviously for a pop. Because the spread traded for $1, I don't know why you would want to just sell the spread naked for $1 when the stock's trading $7.84. That doesn't make too much sense to me. So it feels like they're just, selling out their 10-level call and rolling. Now, they could have scooped this a little lower. Don't quite know what the deal is. But that to me just looks like they're trying to widen out their spread. I would not be surprised tomorrow if the open interest showed 20,000 of the Jan 7s and, over 20,000 of the 15s. And now they're long, that spread.
So this guy's had his heart broken here in Sangamo. It's trading $7.84 right now. He was loving it for the 10-15 spread. Now perhaps thinking better on that here. And looking here, this thing did flirt with 11 not too long ago, back in April. It traded nearly 11. So he had better opportunities to unwind this if that's what he was looking to do. I'm not sure when he opened this. I'll have to dig into the open interest here. But yeah, it looks like he's given up the ghost here.
It feels like he wants to stay in for, let's just call it the long haul. And he wants a little more gas at the money. So it's only costing him $1 for, $3 more bucks. I guess if you want to own it, it's not an unreasonable trade. But he is spending some more money, and I'm not sure if he made enough on the initial transaction, but it feels like they're spending a little more dough on it.
Well, that's a whopping $2 million to put down, add to the line there. So that's not an insignificant amount of funds to add towards rolling this thing. So this guy really must have some love here for Sangamo Biosciences Inc. Interesting. So again, this is my watch list every day. Today. Yeah, 1,800 contracts a day. They're averaging doing 40,000 today. All of it pretty much in this 20,000 lot call roll. So another one to watch here, perhaps put in our watch list to see what the hell's going on here with Sangamo and why this guy may be adding another $1 million to his stake on the table here before he gives up the ghost entirely. Interesting stuff, good stuff indeed, Andrew. But now we're going to keep on rolling right on into the Express Block.
The Express Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the Express Block. This is, of course, the portion of the program where I sit down with the Viceroy for a nice fireside chat about all the latest developments and interesting things going on behind the curtain over there at OX. Now, Alex, I hope you have your smoking jacket on and you're relaxing by the fire for our fireside chat, because I think there's a lot to hit upon over there in OX land. What would you like to start off with today, sir?
Well, I'm going to touch on the Idea Hub, but I'm going to tell a avid listener story. First, I was at dinner with my wife and daughter the other day, and wearing my Options Express by Schwab polo shirt, and we're talking about the show, and as is common for me, I have known to have been a little loud.
I don't believe it, Alex. As someone who is accused of the same thing on a regular basis, I can certainly understand.
And I'm talking about, actually, we were talking about the show numbers and the number of people who listen. And somebody comes over to the table and does the standard, "Excuse me, but are you?" And I said, "Yeah." And he said, "Do me a favor." And I said, "Okay, what's that?" He says, I trade in a 401k. All I can do are covered call rights. I can't do the iron condors and all that fancy stuff." He said, "Put a covered call right up on the show." So went to Hub before the close of business today and looked for something with a Chicago flavor. And let me do all the legal caveats first. Do not try this at home without a consenting adult. But please, before you enter into any trade, have a keen understanding of the risk and reward. But United Airlines, going to take a local name. Airline stocks are like real companies again. They're actually making money, and the request was for a covered right. So one of the 45 buy rights on Hub today was buy United, trading about $32.60. Sell the September 33 strike call, just a little bit out of the money, but trading for $2.50. That's 7% cash on cash return if the stock just sits there. in a world where yields are nothing for the period between now and September. But again, the caveats. If you don't like United, it's not a good idea. But it covered right out of the hub today. And
yeah, that's a fairly juicy one. That's the stock closed $32.66. So that pretty much covers you all the way down to $30 even pretty much on that trade. That's not a bad one. Yeah, that's a decent return. And you have to love it, Alex. We talk here all the time on the show about, the numbers, and we talk about them in aggregate because they're kind of hard to wrap your head around, though. But that's a nice anecdotal way to see when someone comes up to you in the show or at a restaurant or whatever and mentions that they love the show. That's the kind of feedback we love to get. And it just encourages us to keep doing this show here because we love to hear from you, the listeners, as we will a little bit later in the old show. But yeah, that's an interesting one. And it's funny, Alex, I brought up my own screen to follow along with as you were talking about United Airlines here, and it came up right on its own to the SEP 33. So I guess my screen was agreeing with you that is a good trade indeed to investigate. And I'll leave it at that.
Yeah, it's part of what we do in Hub is we try to showcase attractive rates of return. But, one of the caveats is, in fact, I did a Hub webinar yesterday. And one of the names that kept coming up on the covered right screen recently was JCPenney, for kind of all the obvious reasons. And so, I throw that out to investors. Don't do things just because the numbers look good if you're not comfortable with the underlying name. Investors have a bad habit of doing that all the time. And I tell this story about when I worked at Merrill Lynch a long, long time ago. Every Sunday night, they generated a covered right run. And this is so long ago that I'm talking about a physical run of paper. And, of course, the top 100 juiciest covered rights were names that nobody had ever heard of, trading incredibly high volatility and incredibly low liquidity. And a lot of people wouldn't want to trade those. In fact, I don't know many people who would want to trade them. What we do in Hub is we screen for good liquidity, and we try to screen out excessive volatility. So we'll throw things out that are trading 80 or 100 vol because we just don't want to showcase those. If you want to do those, there are other tools you can use. But one other thing I want to showcase, and I've talked about this a couple times, is our walk limit feature, which is essentially an automated cancel and replace that's done over 1 million contracts since it was introduced. And I'll be sort of quick here. Essentially, what walk limit does, it allows you in a spread trade, not in a single leg trade yet, and that has to do with exchange cancel fees, which we don't pass on. But in a spread trade, it allows you to enter a limit. If you're selling for credit or buying for debit, you can enter a limit. Let's say the spread is trading $1.10, $1.60, 50 cents wide. It will allow you to enter if you're selling for the credit, it would allow you to enter a $1.35 limit, the middle of the range. And by the way, it doesn't have to be a $1.35 limit. You can now customize that limit, and you could say, look, I want to sell this $1.40 or better. Leave it out there for right now. It's 2 seconds. If it doesn't fill at $1.40, if it didn't find maybe some dark liquidity or a limit order or a market maker who wanted to respond, walk it down. Walk it from $1.40 to, depending on the instrument, if it trades in pennies, walk it down to $1.40. Auction it for 2 seconds. If nobody fills, walk it down to $1.39. Walk it down to $1.38. It's been customizable as to start price and end price. Next week after expiration, we're going to let you adjust the time too. So right now the time has been 2 seconds for each auction, but we're going to allow you to customize that so that you can say, try to sell it for $1.40, leave it out there for a minute, leave it out there for 5 minutes. If it doesn't get filled, then walk it down to $1.39. So that's really a cool feature. And the way I know it's cool is it's done over 1 million contracts in the few months it's been up. And every time I demo the hub, when I bring up condors, I bring up the walk limit, and I find a lot of people are as if not more interested in the walk limit than they are in the hub. But after Friday's close next week, it's going to have customizable time as well as customizable start and end prices.
Good stuff. As always, Alex, we'll look forward to that upgrade to the walk limit. And I can just anecdotally add to the evidence in support of the walk limit. I've talked to several basic retail options traders and walked them through a few examples of how to do certain things. And the thing they keep coming back to is, I have to manage these trades all the time and things like that. And once I've shown them the walk limit, their eyes do indeed go quite wide. So I agree with you. It perhaps is even more impactful, some of these traders, than the option strategies themselves, because they're just so busy with their day jobs, they can't sit there on their screens all day and watch these things. So something like walk limit makes it much more practical for them to actually get some liquidity and get their trades off at reasonable levels. But now it's time for us to keep on rolling with the show right on into the next segment. This is, of course, the segment where you get to take the reins. It is the listener mail segment.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, and welcome to the mail block. Of course, this is where you, the reader, get to take over the reins of the show. We're going to kick things off with a very well-timed question from Miss Jillian T. And she writes, why is it so difficult to crack down on insider trading and options? Well, if you listen to the top of the show, Jillian, we did hit on this a little bit. We talked about this at length, this specific topic, at our Unusual Activity Forum back in May, almost exactly a month ago now. Like I mentioned, we're going to have all of that material up on the site sometime in the next few weeks, so you can hopefully check that out for yourselves. But in a nutshell, there aren't many SEC enforcement actions in a given year, somewhere around 60 in 2012. So the numbers are very small to begin with. And then, of course, the number that actually involve options are an infinitesimal fraction of that. So it makes it very difficult to crack down on these things. And there's a number of other reasons, too. Options enforcement on this kind of thing wasn't very good until recently, when the exchanges really got their acts together and started sharing data across different exchanges. We, of course, have linkage and other things now that allow us to track customer liquidity across multiple exchanges. You can't hide your trades by opening on the Philly and closing on the CBOE and things like that anymore. So that has helped a little bit. But also, there's also a lack of sophistication still with a lot of the regulators into what is actually going on in the option space. And once you get outside of the very basic buying the out-of-the-money call and then the underlying rallies type trade, it really does fall outside of their bailiwick. You start getting some of the more complex trades that try to profit on volatility perhaps, or trades where the insider is a little bit more sophisticated and he tries to hide his activity by gaming a buy closer to the bid or perhaps even on the bid, and showing perhaps some fake interest in the option to try to disguise his activity, or spreading his activity across multiple strikes in series, which makes it difficult to track down. There's a lot of ways that a sophisticated insider can use the options market to great effect that make it very difficult for the enforcement arm to track them down and actually crack down on them. So there's a number of reasons for that. Like I said, we went into great detail on that at our event recently. You can learn more about that soon. But in a nutshell, it's a very sophisticated product. It's sometimes, unfortunately, perhaps beyond the reach of some of the regulators who are actually enforcing that. Of course, their main mandate, remember, is the underlying market. Options are very much a secondary consideration for them anyway. So when they're off there and they can't even crack down on a Bernie Madoff, which is a very large scam in the underlying stock market, they have very little chance of cracking down on the options market. Of course, this recent investigation with the Thai trader and Smithfield Foods, and of course the high-profile trades with Buffett recently and his acquisition of Heinz, they're starting to put options a little bit more in the spotlight. So I'm hoping that we're going to see a reversal of this trend in the months and years to come, as we're starting to see more options in the focus, because quite frankly, most of the sophisticated insiders are using options. They're not gobbling up tons of stock ahead of a merger. They're buying options on it. And so this is something that we really need to, as regulators in particular, really need to get a handle on. And hopefully they're starting to do exactly that. All right, next up, we have a question from Doug K. out of scenic, sunny and warm Halifax, Nova Scotia. And he writes, I've been long SPY shares for much of the recent rally. Now, I'm more than a little concerned. I've learned about collars through the great shows on this network. Do you think this is a good environment to consider a zero-cost collar? Is a SPY put/put spread a better option, or would you recommend something else entirely? Thanks for all of your insight over the years. This is normally where I would toss it to Uncle Mike, because this is right up his wheelhouse for collars for reticent clients. Of course, he couldn't make it on the show today, so we'll just soldier on without him. Maybe I'll start the ball rolling, then Andrew and Alex, you guys can dive in. I always get a little leery in general when people start talking about zero-cost collars, because they fixate so much on that zero-cost component to it, which means usually you're setting up the entire collar in the same expiration month, which most of the data has shown is not the optimal way to construct them. If you know anything about time decay and how that works, you need to set up your collar in a certain way to really maximize the benefit of it. And what a lot of data recently has shown is that somewhere in the 6-month range for the put is optimal, combined with a front month or perhaps even shorter, perhaps even weekly call right to maximize the decay on that range. And that seems to be the optimal construction. Of course, if you're concerned about very, very near-term risk, and you're worried about the S&P taking a downturn after today or the next few weeks, then a front month zero-cost collar is not going to hurt you. It's going to it could be a good way to help you sleep at night if that's what you're really concerned about. But I would certainly opt for a collar perhaps before even a put or put spread. I think for what you're concerned about, it doesn't sound like you want to sell the underlying. You want to hold on to it a little bit, but you're concerned about some near-term downside. A collar, even a zero-cost collar, is a great way to let yourself sleep at night in this type of environment, and that's a very good thing. Mr. Andrew, what would you say here to our friend Doug from Nova Scotia?
Doug from Nova Scotia, I do like the, buy some puts farther out and then sell the calls kind of strategically against them. You have so many weeklies now. You can do 1 week out, 2 week out. You don't have to be stuck with the, it's a little more work. It's more commissions, but you also really have a much better opportunity to participate in the upside. So because you have more control over the option on a weekly basis. The market has a hard time going up 1% or 2% every week. I mean, it has done that, but it's certainly difficult for it to maintain that. So at least you get an opportunity to have a little more control over what you want to do.
Yeah, people always react sometimes negatively when I say that they should set up their collars like that, because they focus on that initial outlay and they say, wait a minute, I'm paying money for this collar. But they don't realize that if over the lifetime they can probably make a lot more and probably at least pay for the premium of the puts, if not make a lot more than that by writing the call strategically. And of course, as you said, Andrew, you can adjust as the underlying moves. You can adjust that call right, where if you just do it all in 1 month and set it and forget it, it's never optimal. You're always setting it up because you're trying to make the premiums match up. And so you're buying a put you probably don't want. You probably would like a different strike put. You're writing a call you probably don't want. You probably would write a different strike call if you wanted to do it optimally, but you're making it line up from a premium perspective. So the zero-cost collar, never optimal. It's usually better to construct it. And you're right, it costs a little more, it takes a little bit more time, but over the long run, it's a much more preferable scenario to do the optimal collar and adjust it than to just do this zero-cost thing and set it and forget it. Mr. Viceroy, what say you to our friend from the frozen north?
You guys got it spot on. Buy the put long, sell the call short. In your heart of hearts, do you really want to sell the call, or are you just trying to cheapen the cost of the put? I think that's a fundamental question everybody has to ask. We've all talked about this before with I'm yet to meet anybody who really wants to sell that call, but I meet lots of people who don't want to pay for the put. If it's a large account and it has portfolio margin, I would hedge using the SPX. So I've got cash settled instead of the SPY, and that way I've got some real interesting tax games I can play, and my position stays intact. Even if it runs up and my call ends up in the money, I can cash settle. So some of this depends on account size and transaction costs, and that comes back to account size. But the core thing to take away is buy the put long, sell the call short.
Yeah, we don't know what kind of account size Doug is working with here, so we don't have all the information. But sounds like he's on the right track. And you're right, Alex. He probably is Not a big fan of writing the call, but wants to do it to help himself sleep at night when he's spending all that money on the put, and doing an optimal collar is certainly a better way to do that. Great question, Doug. Hope things are nice and breezy up there in Halifax right now. Never gotten up there myself. Maybe we'll do a live option block from there someday. All right, and last up on the old mail block today is a very aptly named T-Bill writes in, hits on a question we've hit on a couple of times in the past on the show, but it's been a while since we've discussed it, and it comes in so frequently I think it's worth overviewing every now and then here. Mr. T-Bill writes, does OX defer commissions when I close out short options for pennies? And Alex, we've hit on this a few times. Why don't you clarify things for our friend here, Mr. T-Bill?
So if it's done electronically, yes, we lower the commission. Any closing on an option trading 5 cents or less, 1 to 10 contracts is $4.95 flat rate. Over 10 contracts is 50 cents a contract, but we don't charge to use the trading desk, and I literally sit across the counter from the trading desk. And I would encourage use the trading desk if you're going to do this, especially if it's, 3 days before expiration and the market to close is, 0 to 20 cents. It's some obscene market. Use the desk. Sometimes they can find liquidity. We have upstairs liquidity providers. We have people who do want to take the other side of this. Sometimes when the floors are a bit lethargic or slow to update quotes, I know that frustrates a lot of people. And if you're going to use a desk and you got a size trade and you trade a lot, negotiate with them a little bit. Ask them to, it's a closing transaction. Ask them to adjust the commission and see if we can't do better than the $4.95 or the 50 cents contract.
Great advice there, Alex. I would just actually mentioned this, Mr. T-Bill, something I noticed myself this morning. I was closing out some trades, I believe, on Ford for about that price, a couple of cents, some shorts, and I noticed that on the OX website, this wasn't in the app, this was through the website, they actually flagged it. If you notice, T-Bill, next time you do these trades, if you're on the website, you'll notice looks like a little cents symbol above the contract, and that will actually, if you highlight that with your mouse cursor will say this trade qualifies for reduced commission. So they do clearly spell that out, at least on the website. If you're looking at some of your positions and you're about to close them out, they will highlight the ones that do qualify for these deferred commissions. So if you have a question about that, then hopefully the website will clear that up for you. And if not, of course, you can do what Alex suggests and just call up the desk, and whatever you're doing, whatever your scenario is, you should be closing these out. You're on the right track there, T-Bill. Don't let commissions keep you from taking risk off the table, particularly if you've made money on these things. Pigs get fed, hogs get slaughtered. If you wouldn't sell the contract again for a penny, by all means, close it out. You don't need to have it on. The broker doesn't want you to have it on, which is why OX subsidizes some of your costs here. It's a good thing for you. It's a good thing for them. Close it out. Move on to the next trade. Live to fight another day. And speaking of another day, it's time to close out this segment and roll on into our final segment, Around the Block.
Around the Block.
All right, and welcome to Around the Block. This is, of course, the portion of the show where we talk about what's on our horizons for the rest of this week into the weekend. Mr. Andrew, we'll start with you. What is catching your eye here for the rest of this week into next week?
Just really seeing how the market's adjusting to we just posted a blog, the same idea, market's adjusting to the fact that the Fed is it's there, but you have to lessen your dependence on central banks at this point. The banks have done all they could. It's time for fiscal policy. And, the global economy is not doing awful anymore. Europe is still really sluggish, but, they have to basically kind of unwind what they used to do. And I think the biggest problem is all this Japanese volatility is keeping I don't think it's we're not really a 13 VIX market anymore. We're more like 14, 15 is kind of the new low, it feels like. So I think we're going to have a lot more 1% up and down moves, just depending on whatever the headline news is for the day. And I think we just kind of more of a trading markets. No, I don't see us getting that straight up launch that we sort of enjoyed here for the first part of the year. It'll be a little choppier. So looking for more kind of short gamut trades away from the market, as it were.
So you're saying we can't just keep printing these 1.5% up days all year long? That's not going to happen anymore, Andrew?
Well, it's like 1.5, then 1, then 0.5, then 3. It's we're going to have them, but then we're going to be followed by, the Bank of Japan's doing this or that. I just feels like we're more in a choppy, we're in more choppy trade than we had, for a good part of this year. Most of the year is kind of low vol straight up, and I think that's not going to be the recipe for the end of the year.
Gotta love these thin summer markets. They make it so fun. And they're actually good times for options traders looking for a little bit of vol, a little bit of gamma, a little bit of activity to wet your whistle. There are some options, pun intended, in the marketplace right now. Mr. Alex, what is catching your eye for the rest of this week into the weekend, sir?
I'm on the same page as you and Andrew. Markets are thin. You've got macroeconomic events going on. I look at the 10-year. And it's kind of curious that since SGMO announced they're going to have a 10-year volatility benchmark, the realized vol in 10 has been around 30%, and it's normally, single digit. I would not panic on these days when, you kind of turn on MSNBC or CNBC or Bloomberg in the morning while you're brushing your teeth and they're saying that, Japan is going down in flames. Look at the 10-year. We're 16 vol on the VIX to both your and Andrew's point. That means 1% plus or minus days are commonplace. 16 implies that a standard plus or minus one standard deviation move is about 1% a day. It's for the quick dirty number, it's the square root of 256. It's a little more detailed than that if you want to dig down into it. But I just wouldn't panic on these days. Markets are thin. Look at the macroeconomics. 10-year, a little over 2. 10-year gets 2.25. I think we're still okay. 10-year starts to pop over 2.5 up to 3, the way a few people are calling for. That's going to indicate the market is capitulated and thinks the Fed's going to stop. And they haven't said that yet. So keep an eye on macros.
Mr. Macro strikes again. Thank you, Alex. And unfortunately, that's all the time we have for today's Option Block program. I, of course, want to thank all of my cohorts for joining me on the show today. Even Uncle Mike, who couldn't make it, will give him a quick plug to check out what they have going on over there at RCM Asset Management, including the resumption of their webinar train next week with some interesting stuff. And they have an interesting new futures options series going on over there as well. So check that out over there at RCM Asset Management. And Mr. Andrew, what is cooking in the land of the pit, sir?
Our gold boot camp starts, not gold boot camp, but it's our option pit boot camp end of June. So actually we just finished putting the finishing touches on the material today. And it's kind of it's a nice intro into volatility, how it affects option prices also, and hopefully to make you choose better trades to get what you want. So, even if just hedging stock or something along those lines, it will be very helpful and helps you understand, basically why the market does what it does.
I like that. Check that out over there at optionpit.com to check out that gold course and everything else you guys have cooking over there in the land of the pit. And last but not least, Mr. Alex, what is cooking in the land of OX?
So I'll just showcase a couple webinars, and a lot of the webinar train right now is really about the enhancements to the site. Tomorrow we're going to be showcasing the new streaming charts, and we have the ability to chart and compare implied vol. That's at noon tomorrow. On Monday, webinar on relative strength indicators and stochastic relative strength. And something I forget to talk about a lot on Tuesday, Joe Cusack, our head of education, is going to do a delta dissection and what it means and how to use it. And all the educational resources here at Options Express are free. You don't need to have an account. Just come to the site, optionsexpress.com, click on the education tab, and you're in.
Delta dissection sounds like something I did in 10th grade biology, but I'm looking forward to seeing what that involves. It might be interesting, might be a little bit gruesome. Check it out over there at Options Express for yourself. Listener, and speaking of checking things out before we go, I do want to mention the latest addition to the ever-expanding Options Insider Radio Network. That is the Wide World of Options. It launched a week ago today, hosted by my friend Joe Burgoyne over there at the Options Industry Council. It is indeed, like the name suggests, a look at the wide and wonderful world of options in all of its many forms. They get into a little bit of education. They get into some interviews. They do some look backs, and they have a lot of great stuff going on that show. So check it out, the wide world of options. It's available wherever you find our Options Insider Radio programming. So that's on our site, in iTunes, Stitcher, AHA Mobile, pretty much anywhere you want. Add it to your RSS feed player of choice via RSS, however you want to get it. The wide world of options. Check it out. I think you're going to like it. And on behalf of Uncle Mike and Andrew and Alex and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, and indeed to the entire network. We couldn't do any of this stuff without you guys. You really have made it just a fantastic process doing these shows for you week in and week out. And we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.